Hello, my friends, and welcome back. Today is April 10th, 2024. My name is Hammer, and I am here with your weekly mortgage market update, letting you know what's going on with mortgage interest rates, why they're moving, how they're moving, to help you to make great decisions if you are looking at buying a home, refinancing, looking at where mortgage rates are going, and things like that. So remember, if you are watching on the replay, do me a favor, let us know. Go ahead and put a hashtag replay in the comments. Feel free to tag me. You can use @Hammer, and you will find me to pop up, and I'll be glad to answer any questions that you have about this. We do monitor this post, so go ahead and share any questions or share your thoughts. So with that said, let's go ahead and let's talk rates. Again, I'm going to keep this short and sweet so that you guys can see exactly what's going on, and we'll make it nice and easy for you. So remember, when we talk about rates, this is not an offer to lend. We're talking about averages and generalities. You generally want to be shopping your interest rates as we go. So quick recap. What happened last week? Well, unfortunately, mortgage rates started to move higher. They moved slightly higher when we got a mix of strong economic and labor data. And we got a lot of labor data last week. Now, why does that matter? Well, the labor data makes it much less likely that the Fed is going to cut rates until later in the year. And we've seen the Fed raise rates many, many times, about 11 times over 18 months. And that's what brought rates from the lows that we saw during the COVID pandemic to where we're at today, right? So generally, if you were shopping around for mortgage rates today, you're going to find VA rates are generally in the mid to high sixes, depending on your credit score and your unique situation. You may even find in the low sevens. Conventional rates are generally in the low to mid sevens right now, and which is very much where they've been for most of the year. Now, this is where rates have settled in, and I know many of you are looking and you say, Hammer, why shouldn't I wait to buy until rates go down? And the reality is that rates are just not likely to go down anytime soon because of what we're facing. Now, in order to see rates go down, we would need to see a labor market that was starting to get weaker, meaning that people were starting to lose their jobs, unemployment would go up, layoffs would go up, and we're not seeing that. Now, there's a lot of small nuances to the labor market. We see a lot more jobs being created that are part-time jobs. We know that they're not necessarily high-paying jobs, but overall, they're still jobs. And as far as the economy goes, today we got inflation data that came in, and it showed inflation actually ticked a little bit higher than what was expected. It's really kind of leveled off. We had seen inflation cap out around 9% in June of 22, and it just kind of refuses to get much better than where we're at now. And we're in the low threes right now on inflation. So that kind of puts us with where things come next and kind of where a forecast is. And here's basically what's likely to happen. Rates are likely to creep higher this week. And actually, they're not just going to creep, they're going to jump. I wrote this on Monday, as I do every Monday. And we got the inflation report today, and that inflation report was not very helpful. In fact, let me go ahead and let me see if I bring this up for you, and we'll take a look together right here. So the inflation report that you're looking at here showed that the month-over-month inflation on what we call the headline number, inflation was up 0.4%, and it was estimated to be up 0.3%. It came in hotter than expected. Now, a lot of economists look at what we call the core number, and what that does is it strips out energy and food prices because they can move up and down. Think about gas prices based on the price of oil. Think about food prices. They can move up and down. That was up 0.4%, and again, was also expected to be up 0.3%. Now, the month-over-month numbers are what we saw this month versus last month, and that's actually what we saw in March over February. But looking at the year-over-year, inflation, according to this particular report, which is called the CPI, or the Consumer Price Index, it's put out by the Bureau of Labor Statistics. This is the actual report and what it looks like. All right. And it's released, and you can find it online. And not that you want to go deep digging into it and reading it, but we kind of see the whole thing. But basically, we've seen a lot of numbers going up with shelter prices, rent prices, insurance prices, things for like property insurance, more so automobile insurance. A lot of the prices of goods that have moved up and have changed and gone up significantly. Airline fares jumping significantly. A lot of these things that we look at. So basically, where does that put us in again? Unfortunately, it puts us in a position where rates are creeping higher. We saw a big jump in rates today. If you got a rate quote over the last couple of days. If you got a rate quote Monday or even yesterday, today's going to be very different. You're going to find rates probably moved about a 0.25% today overnight. So if you were quoted 6.75 yesterday, today, and you get a rate quote of 7, they're not lying to you. The reason that we saw this big move was because of how mortgage rates reacted to this data. And if you want to get into the nuances of it and kind of all the deep stuff, basically we look specifically at what we call mortgage-backed securities. And we watch these fancy, pretty charts here, and we see what happens. And when you see a big red line like that, that's today. This is bad. This is a very bad line. And you could see that, imagine that this is inverse to mortgage rates. So when you see how we kind of were leveled yesterday, and then today there was a big drop, this big move. That means there was a huge drop. This is inverse to mortgage rates. And basically rates went up that much as you see that big move there. And that's why it's unfortunately a negative situation in where we're at. So rates did jump today, like I said, and basically we've probably seen some of the worst rates that we've seen in the year, not significantly. Now, the good news is we're not in danger yet of seeing rates go up to last year's highs, which we saw in October. In order to see rates that push up into the 8s again, we would have to see concern that the Fed was going to have to hike their Fed funds rate rather than talk about cutting it. We haven't seen a Fed funds rate hike since last July, and that's when they stopped hiking. And the reason the Fed hikes those rates is to fight inflation. So when we get these inflation reports that are coming in a little hotter than expected, it's scary. Now, it did scare the markets. And basically, we're not going to see mortgage rates fall until we see the Fed start looking at cutting the Fed funds rate. Now, the Fed does not set mortgage rates, but what the Fed does influence mortgage rates. Okay, so we're likely, again, it's kind of the whole economy. If as much as it hurts and it's difficult and it's painful, and we know that affording a home is very, very tough right now, but people are still buying. And people are still spending money in the economy. And because of that, it puts the Fed in a position that they can't really look to cut and make things easier, because it will increase the economy or heat up the economy. And when that happens, you have more demand than supply, which means that instead of 3 lovely poker chips to pay for something, right? Instead of those 3, it's now going to cost 5 or 6, and that's inflation. So if the Fed cuts rates, if things were to come down, that's going to drive prices up, and that's going to happen to home prices too. And that's something that you want to make sure that you remember, because right now, why is now a good time to buy a home? Why wouldn't you wait until rates drop? Because when rates do drop, it's likely we see home prices that will push up even faster than what we're seeing today. And that's why you want to talk to a mortgage professional. Again, it's not likely that we see rates drop anytime soon. Rates aren't likely to fall much until later in the year, when it becomes more likely that we do see some of those Fed rate cuts. So I do see some of your comments here, and thank you guys for joining me. Always appreciate you being here, and thank you very much for that. So I'm going to go ahead and wrap it up. Remember, I do post something for you each week if you guys are interested. I don't necessarily post to the times anymore, so why don't we go ahead and take that off to the screen. But do look back. If you have questions about what's going on with mortgage rates, let me know in the comments. I'll be glad to answer them. But otherwise, you can come and join me each week. Another little thing is here. Hold on, I'll find it. Where are you? There it is. You can join me each week as we talk about what's specifically going on with mortgage rates with an unbiased opinion to give you the intelligence, the data that you need to make a good decision so that you could feel comfortable. And again, I know that we want to see mortgage rates that are lower for you. We want to see more affordable payments, but it's not in the cards right now. It's just, I love my stuff, right? It's just not in the cards right now. We're not likely to see that happen. It doesn't mean it's a bad time to buy a home. It just means that you have to look at, kind of how everything affects you. So be sure to talk to one of our mortgage professionals. You can find one at vettedva.com. My name is Hammer, and I'll talk to you guys next week. Take care, everybody, and have a fantastic day.